Have you ever wondered how economic crises can change the world? This seemingly simple question leads us into a complex web of financial intricacies and societal impacts. An economic crisis, by definition, is a period of significant decline in economic activity, a downturn that can send shockwaves throughout societies and economies worldwide. But how does this actually play out? Well, these crises often trigger major power shifts, both within nations and on the global stage. Economies that once thrived can find themselves on shaky ground, while others seize the opportunity to rise. Moreover, economic crises can exacerbate wealth disparities, deepening the divide between the haves and the have-nots. This economic disparity can breed social unrest, leading to protests, revolts, or even revolutions. So you see, an economic crisis isn't just about numbers on a screen. It's about real-world effects and transformations, touching every corner of society. To understand more, we delve into history's first recorded financial meltdown. Rewind to the 4th century BC, to the earliest recorded economic crisis in ancient Rome. This time of turmoil was largely brought about by the Punic Wars with Carthage. The immense cost of war strained Rome's treasury, leading to a financial crisis that had far-reaching impacts. One of the most devastating effects was the drastic increase in slavery. As Romans faced financial ruin, many were forced to sell themselves or their family members into slavery to pay off their debts. This crisis also led to a series of reforms in Rome's economic policies. The government implemented measures to mitigate the effects of the crisis, such as debt forgiveness and the establishment of a public bank. The ripple effects of this early financial meltdown were felt for centuries, shaping the future economic policies of Rome and influencing the development of financial systems around the world. Fast forward to more recent times, there are numerous examples of financial meltdowns that have shaped the world. The Great Depression of the 1930s and the 2008 global financial crisis are some of the most significant economic crashes in modern history. Let's take a step back in time to the Great Depression. This global economic downturn was triggered by the infamous Wall Street crash of 1929. The stock market collapse sent shockwaves across the globe, crippling economies and leaving millions unemployed. The causes? A toxic cocktail of poor banking structures, excessive speculation, and flawed government policies. Now, fast forward to the 2008 global financial crisis. The real estate bubble burst, and the banking sector collapsed under the weight of bad loans and risky financial products. The crisis spread like wildfire, affecting economies worldwide. The causes were eerily similar to the Great Depression: lax regulation, reckless lending practices, and the failure of financial institutions. The aftermath of these crises was devastating. Economies contracted, unemployment soared, and countless businesses shuttered. But it also led to significant changes. Governments and financial institutions worldwide were forced to rethink their policies and practices. In the wake of the Great Depression, we saw the introduction of deposit insurance, and the 2008 crisis led to a global push for stricter banking regulations. These measures aimed to safeguard the economy from future shocks. The ripple effects of these crises were felt far beyond their epicenters. They disrupted trade, stifled growth, and deepened income inequalities. Their impacts were felt by everyone, from Wall Street bankers to factory workers in developing countries. Despite the chaos, these financial meltdowns teach us important lessons. They highlight the interconnectedness of our global economy and underscore the importance of prudent financial practices and robust regulatory frameworks. History, as they say, is our best teacher. With each financial meltdown, we've gleaned insights that shape our understanding of economics, and more importantly, guide our actions to avoid similar pitfalls in the future. One of the key lessons we've learned is the importance of financial regulations. These are the guardrails that keep our economic vehicle on the path of stability, preventing it from plunging into the abyss of financial ruin. They ensure the integrity of financial institutions and markets, protecting consumers and maintaining trust in the system. The role of government intervention is another significant lesson. In times of crisis, governments can act as economic shock absorbers, implementing measures to stimulate growth and restore confidence. However, the timing and extent of this intervention can be a delicate balancing act. The dangers of economic disparity have also been underscored by these financial crises. When wealth is concentrated in the hands of a few, it can lead to economic instability. A more equitable distribution of wealth can result in a more robust and resilient economy. Lastly, we've seen the need for global cooperation in managing economic crises. In an interconnected world, a crisis in one country can quickly ripple out to others. By working together, nations can coordinate their response and minimize the global impact. While we may not be able to prevent economic crises, understanding their causes and impacts can help us navigate through them and mitigate their effects. After all, the best way to predict the future is to understand the past.